Welcome back. We are diving right into an analysis report called Revenue Up 20%, breaking down Uber's incredible Q3 report.
It details Uber's Q3 2025 earnings, highlighting a record $6.6 billion net income and that 20% revenue growth. But it also gets into the caveats that led to the stock dipping.
Right, so let's jump straight into that, into the integrity of the core narrative. So a key theme here seems to be this conflict between the headline numbers, which look incredible, and the investor reaction, which was, not so great.
Exactly.
The report makes a really strong case for what looks like a blockbuster quarter. It highlights $13.47 billion in total revenue, a 20% year-over-year increase, and then that enormous record-breaking $6.6 billion in net income.
Yeah, but that's the thing, right? As the report itself makes clear, once you dig in, the picture, it changes completely.
It really does. That $6.6 billion figure included a $4.9 billion one-time tax benefit.
A huge one.
And another $1.5 billion from equity revaluation. So the actual operating income was more like $1.1 billion. Still good, but...
But it's not $6.6 billion. And that situation, it's laid out in the analysis. But I wonder if we've really optimized the angle and originality here by letting that headline lead.
What do you mean by that?
Well, the report's title in the opening, they create this narrative conflict with those crucial operating details. It kind of minimizes the shock value of the fake profit when you finally get to it.
Ah, okay.
The core weakness is that by framing the quarter as incredible or blockbuster, the analysis lets that temporary, misleading $6.6 billion number dominate the emotional response. It doesn't challenge it directly.
I see what you're getting at. The material is analytically strong, it has all the right data, but the packaging, it sort of buries the lead. It's like a mystery where the big reveal is in the footnotes.
Exactly. And the analysis itself gives you the proof. The stock immediately fell 7 to 8%. That tells you the market wasn't buying it.
For sure.
So that reaction suggests the headline should reflect the investor disappointment or maybe the true operating strength, that $1.1 billion, not the one-off windfall.
So what's the suggestion?
The suggestion is to really shift the analytical angle, focus on the deception that's inherent in those headline figures. Position this analysis as a corrective lens.
And use the $1.1 billion in operating income as the real achievement.
Yes, make that the story. Don't let the inflated number define the whole quarter. You have to front-load that caveat to build trust with the reader.
That's a powerful structural pivot. But let's talk about feasibility. If we move the caveat right to the top, do we risk turning this from a sophisticated financial analysis into something sensationalist?
That's a fair question, and it's all about the framing. We're not being sensationalist, we're being more analytically rigorous by prioritizing the sustainable number over the transient one.
Okay.
Sophisticated readers expect an analysis to dissect the headlines immediately. If we lead with the $6.6 billion without context, the reader feels misled, and that damages our credibility.
So the real story isn't the big number. It's the fact that they hit a huge milestone in sustained profitability that was just obscured by this random tax benefit. How do we do that structurally?
With some surgical strikes right at the top. For instance, rework the subheadline. Instead of just saying, incredible Q3 report, which validates the big number, you could have a subheadline like, Uber delivers $1.1 billion in operating income, but record $6.6 billion net income masks one-time gains.
I like that. It acknowledges the record, but immediately reframes what success actually means here.
Precisely. Or another way in, you could directly connect that fake profit to the Q4 guidance miss. Treat them as two sides of the same coin.
So the inflated income and the soft guidance are both symptoms of these crazy high investor expectations that the sustainable business, didn't quite meet.
You got it. Linking them immediately establishes the central tension of the story. The stock didn't just dip because of the one-time item. It dipped because even the core growth wasn't enough for Wall Street.
That flow headline, true income, guidance miss, stock dip, it creates a much stronger arc. It turns the report into more of a detective story.
Yes, the goal is to ground a reader in reality before you even start exploring the growth drivers. The first section should pivot fast from that reported net income to the $1.1 billion operating income.
That makes perfect sense. So, now that we're grounded in that operating reality, let's look at the segments. The analysis confirms mobility and delivery are booming. Delivery growth is even accelerating at 25%.
Right, but then you have freight.
Yeah, freight booked $1.3 billion, but it's showing flat year-over-year growth. The material correctly calls it the weak link.
The data is clear, but let's talk about completeness and focus. The analysis correctly says Uber positions itself as a diversified logistics giant.
Right.
So, given that strategic frame, just letting freight stand as a struggle point without digging into the strategic context, it feels like a really big missed opportunity.
So you're saying the weakness isn't the data point itself, but the failure to connect it to Uber's overall corporate strategy.
Absolutely. The weakness is not explicitly connecting this zero growth to either, the broader logistics market or, more importantly, to Uber's own decisions about where to put its capital. If management is saying they're going into spending mode, investing for growth, then why is capital going to a segment with flat returns? It looks like a drag.
So the report identifies the problem, but it doesn't really explore the consequences of that stagnation, especially when you see the amazing margin expansion in the other segments.
Building on that, the suggestion would be to integrate the freight analysis more strategically, explicitly discuss the hard choices management is facing. Do they divest? Do they shrink it? Radically restructure?
Especially since they signaled heavy reinvestment in other areas, like autonomous vehicles.
Exactly. The opportunity cost of keeping a flat freight segment going becomes a critical point for investors to understand. And so, it's a critical area for the analysis to explore.
I agree. The analysis needs more depth, but I want to push back a little. Is recommending divestiture too prescriptive for this kind of report? Shouldn't the critique focus more on challenging the rationale for the investment rather than telling them what to do?
That is an excellent point. And it's about the language. You don't have to say Uber must divest, but you must ask the question. Does continued 0% growth in freight jeopardize the capital needed for higher margin segments?
Right, challenging the strategy, not directing it.
If you're going to label Uber logistics giant, you have to critically examine the pillars of that title. And if one of the pillars is flatlining, the analysis has to treat that as a critical risk, not just a bit of bad news.
That's a much more powerful line of inquiry. It elevates the whole piece. So, let's make that concrete.
First, you have to illustrate the opportunity cost. Contrast that 0% growth in freight with the delivery segment's margin doubling from 2 to nearly 4%. That juxtaposition just makes the cost of those resources so clear.
That connection between margin expansion in one and stagnation in the other makes the strategic choice immediately obvious.
Exactly. Second, the analysis should explicitly connect this flat performance to the analyst's bear case, the $82 price target. Explain how investing in a flat sector could be what limits the upside, what stops them from hitting that bull case of 150.
It provides a clear quantitative link between the segment and the valuation.
Right. And finally, you can introduce this idea of a strategic patience assessment. If this flatness continues for another quarter, how does that affect the credibility of Uber's whole non-platform logistics play?
That moves the analysis from just descriptive to prescriptive in a smart way. What happens if nothing changes?
Which is the real value an expert analysis should provide.
Okay, that really enhances the discussion on freight. Let's shift to the long-term view. What I really liked about this analysis was the clear line it draws between the strong buy verdict and the forward-looking strategies. The Future Outlook section details these pivotal catalysts. The super app strategy with Uber One, the AV partnerships with Waymo and Cruise, and the high-margin ads business.
Those are fantastic assets, for sure. But let's critique the structure and flow. The analyst's verdict, that strong buy with a target around $111, is introduced before these justifications are really detailed.
I noticed that. The report links the bull case to these future strategies, but by putting them at the very end, it risks making them feel like an appendix, like a list of future hopes, rather than integral part of the current story.
That's the crux of it. The connection between today's growth and tomorrow's valuation feels too sequential.
So, by saving the really sticky high-margin components, the super app and ads for the end, the report misses a huge chance to use them as immediate justification for the strong performance in mobility and delivery right now.
That's it exactly. If they're truly driving the bull case, you have to show they're contributing value now.
You're saying we should show the reader why analysts are okay with the spending mode and the guidance miss by proving these strategies are already paying off in the current P&L.
Precisely. The suggestion is to integrate those high-margin components directly into the Q3 segment discussion. When you talk about mobility strength, you immediately pivot to how the super app is increasing customer lifetime value.
And when you talk about delivery margins, you pivot to ads revenue.
Yes. It validates the path to sustainable profitability instantly. These aren't just future ideas. They're offsetting current costs, like driver incentives, which are central to this quarter's results.
Okay, so integrating them earlier gives the strong buy verdict immediate justification. But do we risk disrupting the logical flow if we start breaking up the clean segments with talk about Uber One and ads?
I think the risk of disruption is minimal, and the reward for the flow is huge.
A pure flow based on segment revenue is what a press release gives you. An analysis should organize information by its relevance to the thesis.
And if the thesis is strong buy because of these strategies,
Then you have to show those strategies bearing fruit today. We're strengthening the flow by making it argumentative, not just descriptive.
okay, let's see how that would work. Give me some concrete examples of weaving those future elements into the current quarter's discussion.
Okay, so when discussing mobility and delivery gross bookings, you immediately pivot to how the ads business is helping to offset driver incentives. That's a high-margin business growing fast. It provides real-time support for the core segments.
It instantly eases concerns about margin pressure, which is a key investor worry.
And it changes the narrative from they're spending too much on incentives to they're mitigating that spend with high-margin revenue.
That's powerful. It explains the how behind the profitability improvement.
Similarly, when you discuss that acceleration in delivery growth, that 25% jump, you explicitly link it to the success of Uber One, the super app.
Right, because that's what's locking users in and increasing their lifetime value across both rides and delivery.
That 25% growth isn't random. It's strategically driven by the stickiness of the super app. By connecting those two, the growth suddenly feels sustainable.
And not just like they got lucky with market opportunity.
Exactly. And finally, you mentioned the AV pivot, partnering with Waymo and Cruise instead of burning cash developing it in-house. And you use that in the conclusion to justify the current spending. It shows why analysts view the spending mode positively.
It proves the reinvestment is strategic and capital efficient, not reactionary. It brings the whole justification for the strong buy rating full circle.
You got it.
That brings us to the end of this critique. So, to really maximize the impact of this analysis, we focused on 3 key areas. First, revisiting that main narrative to center the honest $1.1 billion operating income, not the inflated $6.6 billion.
And reinforcing that critical angle right from the title and the opening paragraphs.
Second, deepening the analysis of the flat freight segment. That 0% growth needs to be put in a strategic context, showing the opportunity costs next to the big wins in delivery.
And finally, that crucial restructuring, weaving those future growth drivers, the ads, the super app, the AV pivot, earlier into the discussion.
So you can better justify that strong buy consensus by connecting current strength to future valuation in a much more seamless, compelling flow.
This material is fundamentally strong. It's insightful, it's backed by data. These high-level edits will just ensure the reader really grasps the full nuance of Uber's performance and understands why the stock dipped despite those huge headline numbers.
Absolutely.
We genuinely want to help strengthen the material, so please implement these suggestions and feel free to submit the revised analysis back to us for a follow-up.